I've managed $124 billion through multiple economic crises. I've studied 500 years of financial collapse patterns. And what I'm about to tell you in the next several minutes could be the difference between retiring comfortably or working until you're 70 years old. Here's the brutal truth that nobody else is going to tell you. If you're investing like you did in 2024, you're building your future on quicksand. The ground is shaking beneath your feet right now, and most people don't feel it yet. Let me show you something terrifying. In 1930, the average investor lost 89% of their wealth. Not because they were stupid, not because they didn't work hard. They lost everything because they trusted the conventional system. In 1970, it happened again. Smart people, hardworking people, responsible people watched their savings evaporate while following exactly the advice the experts gave them. And it's about to happen again. But it doesn't have to happen to you. If you're watching this, you have an advantage. You have time. 18 months to be exact. That's what I calculate we have before the next phase of this collapse accelerates to the point where you can't protect yourself anymore. Before I continue, I need you to do something. If you value your financial future, if you want to be on the right side of what's coming, subscribe to Dalio Mentality right now. This isn't just another finance channel. This is your survival manual for navigating the largest wealth transfer in modern history. Because what I'm about to share with you, you won't see it on CNBC. You won't read it in the Wall Street Journal, and your financial advisor definitely won't tell you. Now listen very carefully. The global economy is a machine, and like every machine, it operates in cycles. There's a short-term debt cycle that lasts about 8 years. There's a long-term debt cycle that lasts about 75 years. And there's a geopolitical power cycle that lasts about 250 years. Right now, for the first time since the Great Depression, all three cycles are peaking simultaneously. Do you understand what that means? It means we're not facing a correction. We're not facing a bear market. We're facing a complete reorganization of the global financial system. And if you're positioned like everyone else, you're going to get crushed. Let me tell you about Richard. Richard was 52 years old. He had worked his entire life as an engineer. Smart guy, responsible. He saved diligently. He put 15% of his income into his 401k every single year. He followed the conventional wisdom. 60% stocks, 40% bonds, the classic portfolio that every financial advisor recommends. Richard retired in 2007. He had $1.2 million saved. He thought he was set for life. Within 18 months, his portfolio was worth $400,000. He lost 67% of his wealth. At 54 years old, Richard had to go back to work. He's still working today. He'll probably work until he dies. Richard didn't do anything wrong according to conventional wisdom. He did everything right, and he got destroyed anyway. Want to know why? Because the 60-40 portfolio is dead. It's a relic from a different era, an era that ended in 2008 and is never coming back. Here's what you need to understand. The 60-40 portfolio was designed for a specific environment. An environment of declining interest rates, low inflation, globalization, and American economic dominance. That environment no longer exists. Interest rates hit zero. They can't go lower. For 40 years, bonds rallied as rates fell. That trade is over. Inflation is back, and it's not transitory, it's structural. The global supply chains that kept prices low for 3 decades are broken. Deglobalization is accelerating. Countries are rebuilding domestic manufacturing. That's inflationary. Aging demographics in developed countries mean fewer workers and higher wages. That's inflationary. The green energy transition requires massive infrastructure spending. That's inflationary. And here's the kicker. Governments are drowning in debt. The United States has $34 trillion in debt. Japan has $9 trillion. China has $14 trillion. Europe has another $15 trillion. Total global debt is over $300 trillion. How do governments deal with unpayable debt? They print money. They inflate it away. They devalue their currencies. It's happened over and over throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina. It's happening right now in Turkey, in Lebanon, in Sri Lanka, and it's coming to the developed world. When inflation is high and rising, bonds get destroyed. When central banks print money to finance government deficits, bonds get destroyed. When currency devaluation accelerates, bonds get destroyed. Your 40% bond allocation isn't safety. It's a ticking time bomb. But stocks aren't safe either, not the way you're holding them. The stock market isn't the economy. It's a liquidity-driven casino that's been inflated by 15 years of zero interest rates and quantitative easing. Price-to-earnings ratios are at historic highs. Corporate debt is at record levels. Share buybacks, not earnings growth, have driven returns. What happens when the free money stops? What happens when rates stay higher for longer? What happens when corporations can't refinance their debt? What happens when consumers, crushed by inflation, stop spending, the market crashes? Just like it did in 2008, just like it did in 2000, just like it did in 1973, just like it did in 1929. But this time is different. This time, central banks can't save you. In 2008, the Fed cut rates from 5% to zero. Where are they going to cut from now? They're already near zero in real terms. In 2008, the Fed bought trillions in assets. They've already blown up their balance sheet. There's no bazooka left. You're on your own. So what do? How do you protect yourself? How do you not just survive but thrive during the greatest financial crisis of your lifetime? You stop investing like it's 2024. You stop following conventional wisdom. You stop trusting the same people who got Richard destroyed. And you start building a portfolio for the world that actually exists, not the world that financial advisors want to sell you. Let me break down the three tsunamis that are converging right now. Three massive forces that are going to reshape the global economy over the next decade. If you understand these forces, you can position yourself ahead of them. If you ignore them, they'll wipe you out. Tsunami number one, structural inflation, not the temporary inflation we saw in 2021 and 2022. Permanent, embedded, structural inflation driven by fundamental shifts in the global economy. For 30 years, globalization drove prices down. Companies moved manufacturing to China. They exploited cheap labor. They built intricate, efficient supply chains. The result was deflation. You could buy a television in 2020 for less than you paid in 1990. You could buy clothes cheaper, electronics cheaper. Almost everything got cheaper. That era is over. Deglobalization is here. The United States and China are in an economic Cold War. Supply chains are being rebuilt domestically or in friendly countries. That's more expensive. Labor costs are rising as demographics shift. The baby boomers are retiring. There aren't enough workers to replace them. Companies have to pay more to attract talent. That's inflationary. Energy costs are rising. The green transition requires massive investment: wind farms, solar panels, electric grids, battery factories. All of that costs money. And in the transition period, before renewable energy is fully scaled, we're going to face energy shortages. Higher energy costs feed into everything: transportation, manufacturing, agriculture. Everything gets more expensive. Government spending is exploding. Infrastructure bills, green energy subsidies, Social Security payments to retiring boomers, Medicare costs, military spending as geopolitical tensions rise. How are governments paying for all this? They're printing money. And when you print money, you devalue currency. And when you devalue currency, prices rise. This isn't the inflation of the 1970s that lasted a decade and then ended. This is the inflation of the 1940s. The inflation that came after World War II when governments had massive debts to pay down. That inflation lasted 15 years, and it destroyed bonds. If you held bonds from 1940 to 1955, you lost 70% of your purchasing power. That's what's coming, and your 60/40 portfolio is positioned exactly wrong for it. Tsunami number two, sovereign debt collapse. Governments around the world have borrowed more money than they can ever repay, and the bill is coming due. Look at the numbers. United States debt to GDP is 125%, Italy is 140%, Japan is 260%. These are unsustainable levels. In a normal environment, these countries would default. But they can't default because they control the printing press. So instead, they'll inflate. Here's how it works. If you owe $1 trillion and inflation runs at 7% per year for 10 years, the real value of that debt gets cut in half. You've effectively defaulted without actually defaulting. You've screwed your creditors, but you've kept the system running. Who are the creditors? Bondholders, pension funds, retirees, savers, anyone holding fixed income assets. They're the ones who get destroyed. Their purchasing power evaporates. Their standard of living declines. They're the sacrificial lambs on the altar of government solvency. This has happened over and over in history. After World War I, Germany inflated away its war debts. Bondholders were wiped out. After World War II, the United States and Britain inflated away their war debts. Bondholders lost 70% in real terms. In the 1970s, inflation ran at 9% for a decade. Bondholders got crushed again. It's the oldest trick in the book, and it's about to happen again. But here's what most people don't understand. When governments inflate away their debts, it's not just bondholders who suffer. The entire financial system is built on government bonds. Banks hold them as reserves. Pension funds hold them to match liabilities. Insurance companies hold them for safety. When bonds collapse, the whole system becomes unstable. That's when you get bank failures, pension crises, insurance company insolvencies, currency crises, social unrest, political extremism. It cascades through the entire society. We saw a preview of this in 2023. Silicon Valley Bank failed because they held long-term bonds that collapsed in value when rates rose. 3 other banks failed in the same week. The system almost broke. The Fed had to step in with emergency lending facilities to prevent a complete meltdown. That was just a warning shot. The real crisis is still ahead. Tsunami number 3, deglobalization and geopolitical fragmentation. The world is breaking apart. The globalized, interconnected, peaceful world that we've lived in for the last 30 years is ending. And it's being replaced by competing blocs, trade wars, supply chain disruptions, and eventually military conflicts. The United States and China are decoupling. Technology transfers are being blocked. Trade is being restricted. Allies are being forced to choose sides. Europe is caught in the middle, dependent on American security but economically tied to China. Tensions are rising everywhere. Taiwan, the South China Sea, Ukraine, the Middle East. This matters for your portfolio because globalization was deflationary. It kept costs low. It increased efficiency. It allowed companies to maximize profits by sourcing from anywhere in the world. Deglobalization is the opposite. It's inflationary. It's inefficient. It forces companies to make suboptimal decisions for political reasons. And it creates uncertainty. Businesses can't plan. They can't invest confidently. They can't build long-term strategies when they don't know what the rules will be in 5 years. That uncertainty depresses economic growth. It reduces productivity. It makes everyone poorer. But it also creates opportunities, massive opportunities, because in times of chaos, wealth doesn't disappear. It just changes hands. It moves from those who are unprepared to those who saw it coming. So here's the question. Which side are you going to be on? Are you going to be Richard, following conventional wisdom into financial ruin? Or are you going to be the person who understood the game, positioned correctly, and came out the other side wealthier than before? The choice is yours. But you need to act now. Let me tell you where to hide your money when the system shakes. Let me give you the actual asset allocation that will protect you and grow your wealth through the chaos that's coming. First, understand this. Diversification is not enough. The traditional advice is to diversify across stocks and bonds. But when both stocks and bonds are falling at the same time, diversification doesn't help you. You need true diversification across asset classes that respond differently to different economic environments. There are 4 possible economic environments. Growth can be higher or lower than expected. Inflation can be higher or lower than expected. That gives you 4 quadrants: higher growth and lower inflation, higher growth and higher inflation, lower growth and lower inflation, lower growth and higher inflation. The traditional 60-40 portfolio only works in one quadrant: higher growth and lower inflation. That was the environment from 1980 to 2008. But we're not in that environment anymore. We're moving into a higher inflation, lower growth environment, stagflation, and the 60-40 portfolio gets destroyed in stagflation. So you need a portfolio that works in all four quadrants, a portfolio that's truly balanced, not balanced between stocks and bonds, but balanced across economic scenarios. Here's the allocation. Pay attention because I'm only going to say this once. 25% in inflation-protected assets. This is your defense against currency debasement. Gold, silver, commodities. Inflation-linked bonds if you must hold some bonds. Bitcoin if you understand the risk. Real assets that can't be printed by central banks. Gold has been money for 5,000 years. Every time governments destroy their currencies, gold preserves wealth. In the 1970s, gold went from $35 per ounce to $850 per ounce, a 2,400% return while bonds were getting crushed. Gold doesn't pay interest, it doesn't pay dividends, but it holds its value when paper currencies fail. Silver is gold's more volatile cousin. It's both a monetary metal and an industrial metal. When inflation hits and industrial demand stays strong, silver outperforms gold. In the 1970s, silver went up 4,800%. Commodities are the raw materials of the economy: energy, agriculture, industrial metals. When supply chains break down and deglobalization reduces efficiency, commodity prices rise. From 2000 to 2008, commodities tripled, while stocks went nowhere. Bitcoin is the wild card. It's digital gold. It's scarce. It's decentralized. It can't be controlled by governments. It's volatile as hell, but if you believe that governments are going to keep printing money and devaluing currencies, Bitcoin is your bet that people will flee to an alternative. I'm not saying put your life savings in Bitcoin. I'm saying a small allocation makes sense as insurance against monetary chaos. 25% in equities, but not the equities you think. Not tech stocks trading at 50 times earnings, not companies dependent on cheap debt and consumer spending. You want companies that thrive in inflation, companies that can pass costs to customers, companies with pricing power. Energy companies. When oil prices rise, energy companies print money. They pay dividends. They buy back shares. They're cash flow machines. Utilities. People need electricity no matter what. Regulated utilities can pass costs through to customers. Consumer staples. People still need to eat. Companies like Procter & Gamble and Coca-Cola have brands that allow them to raise prices without losing customers. Defense contractors. When geopolitical tensions rise, military spending increases. These companies have government contracts with inflation adjustments built in. They're recession-proof and inflation-proof. Mining companies. They own the gold, the silver, the copper in the ground. When commodity prices rise, their profit margins explode. Infrastructure and construction companies. Governments are spending trillions on infrastructure. These companies will benefit for the next decade. 25% in real estate and real assets. But not the real estate you're thinking of. Not overpriced homes in bubble markets. Not commercial real estate in dying cities. Farmland, agricultural land. People need to eat. Farmland produces food. Food prices rise with inflation. Farmland values rise with inflation. And farmland pays you income through crop yields or lease payments. It's one of the best inflation hedges that exists. Timberland. Trees grow regardless of what the economy does. Timber is needed for construction. When governments spend on infrastructure, timber demand increases. Timberland has historically returned 9% per year with low volatility. Energy infrastructure, pipelines, refineries, storage facilities. These are toll roads on energy. They get paid regardless of energy prices. They're inflation protected because their contracts have escalation clauses. Water rights. This sounds crazy, but water is becoming scarce. Climate change is creating droughts. Population growth is increasing demand. Water rights in the American West, in Australia, in other water-stressed regions, are going to become extremely valuable. 25% in cash and short-term instruments, but not US dollars sitting in a bank account. You need optionality. You need liquidity to take advantage of opportunities when assets get cheap, but you need to be smart about how you hold that cash. Short-term treasury bills. They're paying 5% right now. They're as safe as anything can be. They give you liquidity and they give you some inflation protection because rates adjust. Money market funds. They invest in short-term high-quality debt. They pay competitive rates. They're liquid. Foreign currencies in stable countries. Swiss francs, Norwegian krone, Singapore dollars. Diversifying your currency exposure reduces your risk if the dollar weakens. And here's the critical part. You hold cash so you can buy assets when they crash, because they will crash. At some point in the next 18 months, we're going to see a liquidity crisis. Markets will panic. Everything will go on sale. The people with cash will make generational fortunes buying assets from desperate sellers. This is the allocation. 25% inflation protection, 25% inflation-resistant equities, 25% real assets, 25% cash and optionality. Is it more complicated than 60-40? Yes. Does it require more thought and more active management? Yes. But it's designed for the world we actually live in, not the fantasy world that financial advisors sell you. Now let me tell you the secret that billionaires know but never talk about. The real secret of wealth preservation during systemic crises. I've studied every major financial crisis in history: the Dutch tulip bubble, the South Sea bubble, the Panic of 1893, the Great Depression, the stagflation of the 70s, the dot-com crash, the 2008 financial crisis, the COVID crash, every single one. And here's what I found. The wealthy don't just survive these crashes, they thrive. They come out richer than before. How? Because they understand something that ordinary people don't. Wealth is relative. What matters is not how much money you have in absolute terms. What matters is how much you have relative to everyone else. If everyone loses 50%, but you only lose 10%, you've gotten richer in relative terms. You can now buy assets from desperate sellers at fire sale prices. This is how the Rockefellers made their fortune. During the Panic of 1893, while everyone else was going bankrupt, John D. Rockefeller was buying up competitors for pennies on the dollar. This is how Joseph Kennedy made his fortune. He sold stocks before the 1929 crash and then bought real estate during the Depression for almost nothing. This is how Warren Buffett made his fortune. He held cash during bubbles and then deployed it during crashes. The pattern is always the same: position defensively before the crisis, hold cash and inflation-protected assets. When the crisis hits and everyone panics, buy aggressively. Buy the best assets from the most desperate sellers. Then hold those assets as the system recovers and reflates. Your wealth compounds while everyone else is still recovering from their losses. But here's what most people get wrong. They wait too long. They see the crisis coming, but they don't act until it's already started. By then, it's too late to position defensively. You're selling into a falling market. You're panicking with everyone else. The time to act is now, before the crisis, before the panic, while you can still reposition calmly and rationally. Let me give you the specific action plan, the step-by-step process for transforming your portfolio over the next 18 months. Month 1, audit your current situation. Open every account: your 401k, your IRA, your taxable brokerage account, your bank account. Write down exactly what you own: stocks, bonds, funds, cash, real estate, everything. Calculate your actual allocation, not what you think it is, what it actually is. Most people are shocked when they do this. They think they're diversified, but they're not. They have 3 different mutual funds that all own the same stocks. They have bond funds that are going to get crushed when rates rise. They have way more risk than they realize. Month 2, start selling the garbage. Sell your long-term bond funds first. They're the most dangerous thing you own. If rates go up, you lose money. If inflation stays high, you lose purchasing power. There's no scenario where long-term bonds are a good investment right now. Get out. Sell your overvalued growth stocks. anything trading at more than 25 times earnings, anything that doesn't pay a dividend, anything that's up 500% in the last 5 years. These are lottery tickets, not investments. You're not trying to get rich quick. You're trying to preserve wealth through a crisis. Sell your speculative assets. Meme stocks, crypto you don't understand, NFTs, SPACs, anything you bought because someone on social media said it was going to the moon. It's not going to the moon, it's going to zero. Month 3, start building your inflation protection bucket. Take 25% of your total portfolio and allocate it to gold, silver, commodities, and inflation protected securities. You can buy physical gold and silver and store it yourself. You can buy ETFs that hold physical metal. You can buy shares in gold mining companies. You can buy commodity futures through ETFs. You have options. Pick what you're comfortable with and execute. Month 4, start building your inflation-resistant equity bucket. 25% of your portfolio into energy, utilities, consumer staples, defense, mining, and infrastructure companies. Look for companies with low debt, high cash flow, pricing power, and dividends. These are boring companies. They're not going to make you rich overnight, but they're going to protect you and pay you income while the world burns around you. Month 5, start building your real asset bucket. This is harder because most people can't just go buy a farm, but you have options. REITs that own farmland, REITs that own timberland, master limited partnerships that own energy infrastructure, publicly traded water companies. Do your research, find quality managers, allocate 25% here. Month 6, hold the rest in cash and short-term instruments, 25%. This is your war chest, your opportunity fund. You're going to use this to buy assets when they crash. And they will crash. Be patient. Don't chase yields. Don't take stupid risks. Just hold cash and wait. Months 7 through 12. Monitor and rebalance. The market is going to move. Some of your positions will go up, some will go down. Every quarter, check your allocation. If one bucket has grown to 30%, sell some and move it back to 25%. If another bucket has shrunk to 20%, buy more and bring it back to 25%. This forces you to sell high and buy low automatically. Months 13 through 18. Prepare for the crisis. It's coming. You can see the signs. Credit spreads are widening. Volatility is increasing. Central banks are losing control. When the crisis hits, don't panic. You're prepared. Your portfolio is designed for this. In fact, you're going to do better than almost everyone else. When assets crash, deploy your cash. Buy the best companies at fire sale prices. Buy real estate from desperate sellers. Buy commodities when everyone thinks they're going to zero. This is when fortunes are made. This is when you set yourself up for the next decade. But you have to start now, not next month, not when things get scary, now, while you still have time. Here's what I need you to understand. This isn't optional. This isn't one strategy among many. This is the only rational response to the environment we're in. The old rules don't work anymore. The old strategies are dead. If you keep following them, you're going to get crushed. I've given you the framework. I've given you the allocation. I've given you the action plan. Now it's on you to execute. Open your accounts this weekend. Look at what you own. Make a plan. Start selling the garbage. Start building the buckets. And if you're serious about this, if you really want to navigate what's coming, you need to be part of a community of people who understand. People who see what you see. People who are preparing the way you're preparing. That's why Dalio mentality exists. This is where we share insights, strategies, and updates as the situation evolves. This is where you get the ongoing analysis you need to adjust your plan as conditions change. Subscribe right now. Don't wait, because the information I'm sharing next week could save you from making a catastrophic mistake. The market analysis I'm releasing next month could help you spot the exact moment to deploy your cash. The crisis updates I'm providing in real time could be the difference between panic and profit. The future belongs to the prepared. The future belongs to people who understood that the old world was ending and positioned themselves for the new world. The future belongs to you if you act now. Stop investing like it's 2024. Start investing for the world that's actually coming. Your retirement depends on it. Your family's security depends on it. Your future depends on it. The clock is ticking. 18 months. What are you going to do about it? Let me tell you about David. David was different from Richard. David was 48 years old in 2006. He was a corporate lawyer making $300,000 a year. He had saved aggressively. He had $1.8 million in his portfolio, and he was smart enough to see what was coming. David noticed something was wrong. Housing prices were insane. His neighbors were buying houses they couldn't afford. Banks were giving mortgages to people with no income verification. The debt levels didn't make sense. Something was going to break. So David did what everyone told him not to do. He sold half his stock portfolio in early 2007. He moved it to cash. His friends thought he was crazy. His financial advisor told him he was making a huge mistake. He was going to miss out on gains. He was being paranoid. David didn't care. He saw the cracks in the system, and he trusted his analysis more than he trusted the consensus. When the market crashed in 2008, David's portfolio only dropped 20% while everyone else lost 50% or more. But that's not the best part. The best part is what David did next. In March 2009, when everyone was panicking, when people were saying the financial system was going to collapse completely, when stocks were at their lowest point, David deployed his cash. He bought aggressively. He bought bank stocks at $5 that had been at 50. He bought blue chip companies at prices not seen in 20 years. He bought real estate from desperate sellers at 40 cents on the dollar. By 2010, David's portfolio had recovered completely. By 2012, he was up 80% from his 2007 peak. By 2015, he had tripled his wealth. And in 2019, at age 61, David retired with over $7 million. Same market, same crisis, two different outcomes. Richard followed conventional wisdom and got destroyed. David questioned conventional wisdom and became wealthy. What was the difference? Information? No. They both had access to the same information. Intelligence? No. Richard was just as smart as David. The difference was mindset. David understood that the crowd is always wrong at turning points. David understood that consensus is comfortable but dangerous. David understood that real wealth is built by seeing what others don't see and acting before they do. That's the mindset you need right now. Because we're at a turning point. The signals are everywhere if you know how to read them. Look at the bond market. The yield curve has inverted 12 times since 1955. Every single time, a recession followed within 18 months. The yield curve inverted in 2022. The clock is ticking. Look at corporate debt. Companies have borrowed $11 trillion in the United States alone. Much of that debt was issued when rates were near zero. Now those companies have to refinance at 5% or 6%. They can't afford it. Defaults are coming. Look at commercial real estate. Office buildings are empty. Nobody wants to go back to the office. Buildings that were worth $200 million are selling for $80 million. Banks have massive exposure. Regional banks are sitting on enormous unrealized losses. Another Silicon Valley Bank scenario is inevitable. Look at the federal deficit. The United States is running a deficit of $2 trillion per year during an economic expansion. What happens when the recession hits? The deficit could go to $3 trillion or $4 trillion. The bond market can't absorb that. The Fed will have to print money. That's more inflation. That's more currency debasement. Look at geopolitics. China is preparing to take Taiwan. They're building up military capacity. They're stockpiling commodities. They're reducing dependence on the dollar. When they move on Taiwan, the global economy will fracture completely. Trade will collapse. Supply chains will break. Energy prices will explode. All of these things are happening simultaneously, and they're all pointing in the same direction, toward crisis, toward collapse, toward a complete reshaping of the financial system. But here's what the financial media won't tell you. Here's what your advisor won't tell you. This isn't necessarily bad. Crisis creates opportunity. Collapse creates the conditions for massive wealth creation. Reshaping means someone's getting richer while someone else is getting poorer. You get to choose which side you're on. The mistake most people make is thinking that wealth preservation and wealth growth are different strategies. They're not. They're the same thing. When you preserve wealth during a crisis, you're automatically growing wealth relative to everyone else. When you have cash during a crash, you have the power to buy at the bottom. That's when generational fortunes are made. Think about it this way. If the market crashes 50% and you're only down 10%, you've outperformed by 40%. You can now buy twice as many assets as the person who rode the market down. When the market recovers, you recover to a much higher level than you started. This is the secret. This is what the wealthy understand. Absolute returns don't matter. Relative returns matter. Beating the market during a crash is worth more than beating the market during a boom. So how do you beat the market during a crash? You've already heard the allocation. Now let me tell you the psychology, because this is where most people fail. They have the right allocation, but they don't have the emotional discipline to stick with it. When the market is crashing, your brain is going to scream at you to sell everything. You're going to see your portfolio dropping. You're going to see headlines about financial apocalypse. You're going to hear experts saying it's going to get worse. Your friends are going to be panicking, your family is going to be scared, and you're going to want to sell. You're going to want to go to 100% cash. You're going to want to hide under your bed until it's over. Don't do it. That's exactly the wrong move. That's what Richard did. That's why Richard lost everything. Here's what you do instead. You stick to the plan. You trust the allocation. You remember that your portfolio is designed for this exact scenario. Your gold is going up. Your commodities are holding value. Your cash is ready to deploy. You're not panicking because you prepared. And when things get really bad, when everyone else has capitulated, when the headlines say the world is ending, that's when you buy. That's when you take your 25% cash and you deploy it into the best assets at the lowest prices. This is the hardest thing to do. Buying when everyone is selling. Buying when it feels like the world is collapsing. Buying when your gut is telling you to hide. But this is the move that makes fortunes. This is the move that separates the wealthy from everyone else. You know what the best investors in history have in common? They're all contrarians. They all bought when everyone else was selling. Warren Buffett bought American Express during the salad oil scandal when everyone thought the company would go bankrupt. Carl Icahn bought airlines after 9/11 when everyone thought the industry was finished. Howard Marks bought distressed debt in 2009 when everyone thought the financial system was going to collapse. They weren't smarter than everyone else. They weren't luckier. They just had the discipline to act when others couldn't. They had the emotional control to execute the plan. You need to develop that discipline now, before the crisis. Because once the crisis hits, your emotions will take over. Fear is powerful. Fear makes people do stupid things. Fear makes people sell at the bottom. Fear makes people miss the opportunity of their lifetime. The way to overcome fear is preparation. The way to overcome fear is having a plan. The way to overcome fear is understanding that you've already positioned yourself for this. You're ready. You're protected. You're going to be fine. Let me give you some specific scenarios and how your portfolio responds. Let's stress test this allocation against different possible futures, because you need to see that this works no matter what happens. Scenario 1, high inflation persists. The Fed can't control it. Inflation runs at 6% or 7% for the next 5 years. What happens? Your bonds get crushed. Good thing you don't own many bonds. Your cash loses purchasing power, but you're earning 5% in treasury bills, so the real loss is only 1 or 2% per year. Your stocks struggle. Most stocks can't keep up with inflation, but your energy stocks do well. Your utility stocks pass through costs. Your consumer staples raise prices. That bucket holds up. Your gold explodes. Gold goes from $2,000 per ounce to $5,000 per ounce. Your commodities rally. Oil, copper, agricultural products all rise with inflation. Your real assets appreciate. Farmland values increase. Timberland values increase. Infrastructure assets increase. Overall, your portfolio is up in nominal terms and flat or slightly positive in real terms. Meanwhile, the 60/40 portfolio is down 30% in real terms. You've outperformed by 30%, You're massively wealthier relative to everyone else. Scenario 2, deflationary collapse. The debt bubble bursts, credit contracts, the economy crashes. We get a depression-level event like 2008, but worse. What happens? Your stocks drop, but you only have 25% in stocks and they're defensive stocks, so they drop less than the market. Your gold holds value or increases as people flee to safety. Your cash is king. Cash becomes the most valuable asset because everything else is dropping. You have liquidity, you have optionality, and then you deploy. You buy stocks at 50% off. You buy real estate at 60% off. You buy everything from desperate sellers. When the market recovers, and it always recovers, you make 300% or 400% returns because you bought at the bottom. The 60/40 portfolio is down 50%. They're devastated. They don't have cash to buy the dip. They're selling to raise cash for living expenses. They're getting crushed. You're getting rich. Scenario 3, currency crisis. The dollar loses reserve currency status. Countries dump treasuries. The bond market crashes. The dollar plummets. What happens? Your gold skyrockets. Gold is the anti-dollar. When the dollar falls, gold rises. Same with silver and commodities. These are priced in dollars, so when the dollar weakens, their price increases. Your foreign currency positions appreciate. Your real assets hold value because they're tangible. Land doesn't care what currency you price it in. Your stocks are mixed. Export-oriented companies do well because a weak dollar makes their products cheaper overseas. Import-oriented companies struggle, but overall your equity bucket survives. Your cash loses value, but you quickly redeploy it into harder assets. The 60/40 portfolio is annihilated. Bonds collapse because they're dollar-denominated debt. Stocks struggle because the economic chaos crushes earnings. People lose 70% of their wealth. You lose maybe 20% and then recover quickly. Scenario 4, stagflation. The worst of both worlds. High inflation plus low growth. The economy stagnates, but prices keep rising. This is the 1970s scenario. What happens? This is actually the scenario where your portfolio performs best. Because your portfolio is designed exactly for stagflation, gold crushes it. From 1970 to 1980, gold went up 2,400%. Commodities crush it. The Goldman Sachs Commodity Index returned 22% per year during the 70s. Your inflation-resistant stocks do well. Energy, utilities, and consumer staples outperformed during the 70s. Your bonds lose money, but you barely own any. Your cash loses purchasing power, but you're redeploying it continuously into better assets. Overall, your portfolio could be up 50% or 100% during a decade of stagflation. The 60/40 portfolio is down in real terms, maybe way down. Do you see the pattern? In every scenario, your portfolio is positioned to survive and potentially thrive. In every scenario, the conventional 60/40 portfolio gets hurt or destroyed. That's the power of true diversification. That's the power of understanding what's coming and positioning accordingly. But allocation is only half the battle. The other half is execution, and execution requires understanding the specific investments within each bucket. Because you can't just buy any gold stock or any energy company or any farmland REIT, you need to buy the right ones. Let me give you the specific criteria for each bucket. These are the filters I use to separate the winners from the losers. For gold and precious metals, you have three options: physical metal, ETFs, or mining stocks. Physical metal is the safest but least convenient. You have to store it. You have to insure it. But it's real. It's yours. Nobody can take it away. If you're worried about systemic collapse, physical metal is your insurance policy. ETFs are convenient. GLD and SLV are the big ones. They hold physical metal in vaults. You can buy and sell instantly. The downside is counterparty risk. You don't actually own the metal. You own a claim on the metal. In a real crisis, that claim might not be worth what you think. Mining stocks are the leveraged play. When gold goes up 10%, mining stocks can go up 20% or 30%, but they're also more volatile. they can go down just as fast. And they're still stocks. They're subject to market risk, management risk, operational risk. My recommendation, split the allocation. 1/3 physical, 1/3 ETFs, 1/3 miners. The miners you choose should have low costs, long mine lives, strong balance sheets, and good management. Look at companies like Newmont, Barrick Gold, Franco-Nevada, Wheaton Precious Metals. These are the best operators in the industry. For commodities, you're mostly limited to ETFs and futures. You can't store barrels of oil in your garage. Look for broad commodity funds like DBC or GSG. These track baskets of commodities, energy, agriculture, metals. They give you diversified exposure, or you can buy specific commodity ETFs, USO for oil, UNG for natural gas, DBA for agriculture. The key is understanding contango and backwardation. Commodity futures can lose value over time due to rolling costs. Do your homework. Understand what you're buying. Or stick with commodity producing stocks instead. Energy companies, agricultural companies, mining companies, these give you commodity exposure without the complexity of futures. For inflation-resistant equities, you're looking for specific characteristics. Low debt. You don't want companies that will get crushed if rates stay high. High cash flow. Companies need to generate cash to weather storms. Pricing power. Companies need to be able to raise prices without losing customers. Dividends. You want to get paid while you wait. In energy, look at the integrated majors, ExxonMobil, Chevron. They do exploration, production, refining, distribution. They're diversified within energy. They pay solid dividends. They're managed conservatively. When oil prices rise, they print money. In utilities, look at regulated monopolies. NextEra, Duke Energy, Southern Company. These companies have government-approved rates. They can pass costs through to customers. They're boring, they're stable, they pay 3% or 4% dividends. They're not going to double, but they're not going to zero either. In consumer staples, look at the blue chips. Procter & Gamble, Coca-Cola, PepsiCo, Colgate-Palmolive. These companies have brands that have existed for 100 years. They sell products people need regardless of the economy. They raise prices regularly and customers keep buying. They've survived every crisis and come out stronger. In defense, look at the primes, Lockheed Martin, Raytheon, Northrop Grumman. These companies have multi-year government contracts. The contracts have inflation adjustments. Military spending is going up, not down. These companies are recession-proof and inflation-proof for real assets. This is where it gets more complex. Most people can't just buy a farm or a forest. You need to use REITs and publicly traded companies. For farmland exposure, look at Gladstone Land Corporation or Farmland Partners. These REITs own farms across the United States. They lease the land to farmers. You get rental income plus appreciation. It's leveraged exposure to agricultural land values. For timberland, look at Weyerhaeuser or PotlatchDeltic or Rayonier. These companies own millions of acres of timberland. They harvest trees. They sell lumber. You get commodity exposure plus real asset appreciation. For infrastructure, look at master limited partnerships like Enterprise Products Partners or Magellan Midstream Partners. These own pipelines and storage facilities. They're toll roads on energy. They pay high distributions. They're inflation protected through contract escalators. The key with all of these is quality. Don't chase yield. Don't buy junk. Stick with the leaders. Stick with the best managed companies. Yes, you'll pay a premium. Yes, the yields might be lower. But these companies will survive. The junk won't. For cash and short-term instruments, keep it simple. Treasury bills, money market funds, high-quality short-term corporate bonds if you want slightly higher yield. The goal is preservation and liquidity, not returns. You're holding cash for optionality. You're holding cash to buy the crash. One thing I haven't mentioned yet, taxes. This is critical because if you're not tax efficient, you're going to give back a huge portion of your returns to the government. Here's the strategy. Use your retirement accounts for your least tax efficient holdings. Use your taxable accounts for your most tax efficient holdings. REITs and MLPs generate ordinary income. That's taxed at your marginal rate. Hold those in your IRA or 401k where the income grows tax deferred. Commodities can generate short-term capital gains. Hold those in retirement accounts too. Stocks that pay qualified dividends and generate long-term capital gains get preferential tax treatment. Hold those in taxable accounts. Municipal bonds, if you hold any, are tax exempt. Those go in taxable accounts. Gold and silver are collectibles for tax purposes. Long-term gains are taxed at 28% instead of 20%. Still, that's better than ordinary income rates. You can hold them anywhere. If you're selling positions to rebalance, be strategic. Sell in December to offset gains with losses. Sell in January to push the tax hit into next year. Use tax loss harvesting throughout the year to reduce your burden. And if you're really wealthy, consider opportunity zones, charitable trusts, and other advanced strategies. But for most people, just being smart about asset location and timing is enough. Now let me address the objections, because I know what you're thinking. I've heard all the arguments against this approach. Objection 1. This is too complicated. I just want something simple. My response. The 60/40 portfolio is simple. It's also dead. The world is complicated now. The solutions have to match the complexity of the problems. Yes, this allocation requires more work. Yes, you have to understand multiple asset classes. But the alternative is getting crushed. Choose your hard. Managing complexity is hard. Losing your retirement is harder. Objection 2. What about my age? I'm 65. I can't afford to take risk. My response. You have it backward. The 60/40 portfolio is the risky option now. Bonds are going to get crushed. That's risk. This allocation is actually more conservative because it's truly diversified. It protects against multiple scenarios, and you still have 25% in cash for safety and income needs. You're not gambling, you're being prudent. Objection 3. What if you're wrong? What if inflation goes away and we go back to normal? My response, then some parts of this portfolio underperform and other parts do fine. Gold might stagnate. Commodities might be flat. But your equities will do okay. Your cash will be fine. You won't get crushed. The 60/40 portfolio only works in one scenario. This portfolio works in multiple scenarios. That's the point. Objection 4. This sounds like market timing. I thought you can't time the market. My response. This isn't market timing. This is risk management. Market timing is trying to predict short-term moves. I'm not trying to predict whether stocks go up or down next month. I'm positioning for a multi-year shift in the macro environment. That's different. That's strategic allocation based on fundamentals, not technical trading based on charts. Objection 5. My advisor says I should stay the course. He says panic is the enemy. My response. Your advisor makes money from assets under management. He gets paid whether you make money or lose money. He has no incentive to tell you to sell. He has every incentive to tell you to hold. And he's using a playbook from a different era. Fire your advisor, manage your own money, or find an advisor who actually understands what's happening. Look, I get it. This is scary. Changing your entire investment approach is uncomfortable. Going against conventional wisdom is uncomfortable. Being different from everyone else is uncomfortable. But you know what's more uncomfortable? Losing half your wealth, working until you're 75, downgrading your retirement plans, becoming a financial burden on your children. That's the path you're on if you don't change. That's where conventional wisdom leads. I've given you the alternative. I've given you the roadmap. Now you have to decide. Are you going to be Richard or David? Are you going to follow the crowd into destruction, or are you going to think independently and protect yourself? The choice is yours, but the window is closing. 18 months, maybe less. The signs are accelerating. The cracks are widening. The system is breaking in real time. Every month you wait is a month you can't get back. So here's what I need you to do right now. Not tomorrow, not next week, right now. Pause this video. Open your brokerage account. Look at what you own. Really look at it. See the danger. See the risk. See the vulnerability. Feel the discomfort of knowing you're positioned wrong. Then make a commitment. Commit to making the changes. Commit to protecting yourself. Commit to being on the right side of the greatest wealth transfer in history. And subscribe to Dalio Mentality, because this isn't the end of the conversation, this is the beginning. The macro environment is evolving. The tactics need to evolve with it. You need ongoing analysis. You need updated strategies. You need a community of people who see what you see. This is your life. This is your family's future. This is everything you've worked for. Don't leave it to chance. Don't trust it to a system that's broken. Don't follow advice that stopped working years ago. Take control. Take action. The future belongs to the prepared. Make sure you're one of them.